Well, and now we are approaching the last session for the morning session under the topic Development, Wealth and Capital Market Strategies. And the next topic is pretty close to us, ASEAN in the Dynamic Global Capital Market by Mr. Jose Camacho, who is the former Secretary of Finance, the Philippines, and the Vice Chairman of Credit Suisse Asia Pacific. Before I invite Mr. Camacho on the stage, I would like to give you his profile before he come up to the stage. Mr. Jose Camacho is the Managing Director of Credit Suisse based in Singapore, and he's the Vice Chairman of Asia Pacific and also the country CEO for the Credit Suisse in Singapore. And he joined Credit Suisse in March 2005, and after a distinguished career in the government and international banking, as Secretary of Finance for the Philippines from the year 2001 to 2003, he led the country's economic team and supervised the fiscal and financial sectors. And Mr. Camacho is currently a board member of the National Heritage Board in Singapore and advisor to the Singapore Institute of International Affairs, a member of the group of experts in ASEAN Capital Markets Forum, a member of Securities Industry Council in Singapore, and also a member of the International Advisory Panel of the Securities Commission in Malaysia, and he is the non-executive chairman of Sun Life of Canada in the Philippines. And now I would like to give a warm welcome to Mr. Jose Camacho.
Ladies and gentlemen, good morning. Very, very pleased to address you this morning to help commemorate the 20th anniversary of the Securities and Exchange Commission of Thailand. I would like to express my warm congratulations to the SEC and, of course, our very distinguished Secretary General, Vorapol, on reaching this significant milestone in its history. When the SEC of Thailand was established in March 1992, it marked a new era of supervision and development of Thailand's capital markets, which had previously been governed under various laws and regulations. I would like to thank the SEC, particularly Kun Vorapol, for the opportunity to be here with you this morning on this very special occasion to discuss the capital markets in Southeast Asia, which play such a crucial role in our region's economic system. The past year has been a very challenging one for financial institutions active in the global capital markets. While Asia, and especially Southeast Asia, continue to enjoy relatively better economic performance, policymakers and regulators charged with ensuring stability and integrity of the region's financial markets also face a historic challenge. To help us all better understand the challenge, the SEC has brought together a wide range of excellent speakers at today's International Symposium, including, of course, Kittiratt, our Deputy Prime Minister and Finance Minister, Sir Howard Davies, Christopher Balding, who you just heard earlier. For my own part, I would like to focus my remarks on the development of domestic and regional capital markets in ASEAN and to offer some suggestions as to how policymakers, regulators, and market participants can work together to mitigate the risks and the challenges we face from the global economic crisis and to capture the opportunities. I'd like to make a correction. I think I was introduced to talk about the ASEAN capital markets in the context of a dynamic global capital markets. I don't think we could characterize the global capital markets today as dynamic. It is in crisis. To provide some context, let me begin by taking a brief look at the bigger global picture. It has become a cliche to say that these are very extraordinary times. But alas, it is very extraordinary times. Back in 2007, the U.S. subprime mortgages sparked off the most profound financial crisis in living memory, overturning many perceived wisdoms about the financial system and the banking industry. The severe financial crisis and the ensuing global economic slowdown left long-lasting scars. The deepening crisis in Europe that has ensued has led many to challenge the structure and nature of the Eurozone. While the European Union Summit last month produced several important announcements that brought temporary relief, and I repeat, temporary relief to the markets, policy action to actually deal with the Eurozone's underlying structural and solvency problems will remain in focus. And austerity measures being implemented throughout Europe will surely dampen the region's economic outlook. Aside from the banking and fiscal crisis, the more profound challenge of how to bring back competitiveness to a number of European economies stuck with an inflexible exchange rate remains unanswered. So personally, my dear friends, I believe that the Euro crisis will be here for a while longer and will continue to send shocks to the financial markets around the world, including our region. So what lies ahead in the near term? The U.S. earnings season is underway, and the bank's earnings releases in particular will be closely scrutinized by the market. For the rest of 2012, our analysts think market sentiment will hinge largely on policy actions to combat the Eurozone debt and banking crisis, the strength or the weakness of the U.S. economic recovery, and the GDP and PMI data coming out of China, where concerns linger around a growth slowdown or hard landing. At this time of global economic upheaval, volatility has become a normality, and in many cases, this has had a negative impact on issuers' ability to raise capital as well as on investors' portfolios. The roots of this crisis are far away from Asia-Pacific, but sadly, we have not been totally immune to its effects. If we look for examples in the equity capital markets, so far this year, some US $5.4 billion worth of deals have been pulled out from the markets or postponed in non-Japan Asia. One name that comes to mind and stand out is the Formula One, which delayed its $2 billion IPO in SGX due to poor market conditions. A further example, in the syndicated loan market, Asia-Pacific borrowers are still finding it difficult to access US dollar or non-local currency liquidity. This is traditionally the most resilient of financing markets. But data firm Dealogic has recorded volumes for the first half of this year at $128 billion, which is 26% lower than the same period last year. Traditional US dollar demand for Asian loans has been reduced as many international banks try and reduce risk in the face of higher capital requirements, increased funding costs, and in many of the European banks, a lack of access to dollar funding themselves. Credit default swap rates across the financial sector has increased markedly. It's natural to be pessimistic at a time like this and to take the view that Asia will eventually simply be swept away by the global events and to conclude that there is very little we can do about it here in the region. But I would like to make three important points. First, Asia's dress rehearsal in the Asian financial crisis in the late 1990s has helped restructure much of its public, banking, and corporate sectors. The region has entered this global financial crisis and the ensuing Euro crisis, for the most part, with stronger fiscal positions, larger international reserves, recapitalized and restructured banking sectors, and a largely deleveraged, more profitable, and cash-rich corporate sector. This has provided flexibility for governments to respond with their policies, It has provided for continued access to domestic financing for corporates. In fact, this has also provided interesting investment and acquisition opportunities for some of the region's more aggressive corporates as some Western investors exit the region and assets become more available and cheaper in the West. Second, let's not forget that the picture on the region's capital markets is not as bleak after all. Allow me to offer some evidence of the encouragingly positive investor sentiment we are seeing in Asia. The Asian US dollar bond primary market has seen a record start to the year, with year-to-date issuance volume of some $62 billion, already surpassing last year's full-year total of $57.6 billion. In Southeast Asia, new issue volume is at a historic high of $16.4 billion, larger than the previous record of $14 billion set in 2009 and $10.4 in 2010. This record issuance volume has been driven by the U.S. Treasury yields hovering near all-time lows due to what they call Operation Twist of the U.S. Federal Reserve Bank and the compression in credit spreads within the Southeast Asia region, with issuers, therefore, being able to lock in long-term funding at attractive all-in borrowing costs. Bond market technicals are also very supportive, with many investors today sitting on historically high cash balances and emerging market bond funds continuing to see strong inflows. Such funds recorded an inflow of $900 million for the week of July 18 alone, bringing year-to-date net inflows to $17 million. It is also pleasing for me to see the strong pipeline of deals in the region's equity capital markets, coming from Thailand, Singapore, Indonesia, Malaysia, and more recently, the Philippines. In fact, there is currently an expected $9.1 billion worth of deals in the pipeline in non-Japan Asia for the remainder of the year. I would also like to highlight the recent IPO from Malaysia of IHH Healthcare, which has become the world's third biggest IPO this year. Looking at the SEC's own domestic market, Thailand has been one of the best performing major equity markets in Asia, growing by 9.4% in this year to date, second only to the Philippines. Not something I'm very often able to say. The Thai market has recently come down a little, having reached all-time highs in June. But from a price-to-earnings perspective, Thailand remains relatively cheap compared to the other Southeast Asian indices. So indeed, there are considerable bright spots. The third point I would like to make is that there remains a lot more room to grow and strengthen our regional and domestic capital markets to mitigate the effects of the global contagion. And there lies the opportunities. We know that we cannot be immune to the problems of the EU and the US. They remain two of the largest consumer and export markets for Asia. It is also clear that the contagion from the European crisis has affected the financial markets in our region, just as we believe weaker economies in the West will inevitably affect the growth rate here in Asia. We know that we live in a globalized and interconnected world. And ladies and gentlemen, we in this region should continue to embrace that. But what can we do to differentiate Asia in these troubled times? How can we ensure that Asia Inc. has continued access to growth capital? Just to be clear, I am not thinking of protectionism or putting up higher walls as a solution to these challenges. I am thinking more of proactivity and a greater degree of regional collaboration. Most of the region's domestic financial markets are very liquid, but cross-regional investments today are still very limited. We have the financial resources to support continued economic growth in the region, but there remains many barriers for such cross-regional capital flows. I have been privileged to sit as a member of the group of experts for the ASEAN Capital Markets Forum for the last few years, together with Kun Banyong. I have seen a lot of progress in the completion of the roadmap mentioned by Kun Vorapol for a more integrated regional capital market as approved by the region's finance ministers in 2009. This roadmap includes specific programs to harmonize market practices and standards, provide for mutual recognition of market practitioners, and many other initiatives. There are also initiatives to directly link the region's stock exchanges. I'm afraid, however, that our ASEAN way has not allowed for a faster implementation of such good regional intentions. As I have mentioned in many regional gatherings like this, we are very good at articulating and planning for regional integration when we are in meetings together. But once we are back in our respective capitals, we often lose sight of the regional agenda and focus almost entirely on domestic issues and vested interests that often conflict with regional integration. Regional financial integration has to be planned at the regional level, but implementation through new legislation, new regulations, new market practices are necessarily at the national level. Furthermore, volatility in global markets reminds us of the fundamental need to strengthen our own respective domestic markets. In the bond markets in Asia, corporate issuance in particular has taken off over the last 5 years. But many of these corporate bonds lack any kind of active secondary market and would benefit from the development of repo markets, certain forms of derivatives, and greater participation from foreign investors, including intra-regional investors. Many equity markets in Asia also continue to suffer from a lack of liquidity, making them very volatile in the face of even relatively small capital flows. There are clear challenges and tasks here for both regulators and policymakers, especially as more robust domestic capital markets are a prerequisite for greater regional integration. At a more micro level, regional markets take time to take root if left on their own. I would encourage Asian policymakers to seriously consider taking the initiative to establish regional bond and equity funds. The Asian Development Bank had initiated the creation of the Asian Bond Fund 1 and 2 many years ago. They were not critical then, during the pre-global financial crisis, but I believe that they are more acutely needed today. Some central banks in the region have already ventured into corporate credits, commodities, and in some rare cases, equities to enhance returns. So why not a large fund that will invest exclusively in non-local currency Asian bonds issued by Asian banks, corporates, quasi-government entities, and indeed even some of the region's governments? Some of the region's sovereign wealth funds and government pension funds have actively invested in international equities. So why not sponsor an equity fund that is dedicated to Pan-Asia or ASEAN public equities? To avoid moral hazard, which I'm very familiar with, I would propose a number of measures, such as having the funds managed by third-party professional managers with the right and appropriate incentive structures, and ensuring that investments by the funds are made strictly on market terms. I believe that such dedicated and government-led Asian funds would go a long way towards building confidence in the region and stabilizing what I call the Asian bid for regional credits and equity stories. It would kickstart cross-regional investing and help ensure that, that financing Asia needs to sustain growth can be met from within. Asian companies wanting to expand at home or overseas, and governments pursuing infrastructure programs and promoting public-private partnerships will find more stable bond and equity markets for long-term capital. On another matter, the crisis of confidence causes investors to be less discriminating, as we have seen in the European government bond markets. Fundamentally strong economies, banks and companies face similar challenges in accessing capital as their weaker counterparts. While one cannot control investors' risk appetite, this indiscriminate risk aversion can be mitigated by more aggressive and more effective investor relations programs, including initiatives targeted at investors within our very own region. We at Credit Suisse have started doing more intra-regional investor roadshows, for example. Issuers need to do more to differentiate their investment stories. Senior government officials should also take all the opportunities available to them to explain how their economies can continue to perform amid the problems in the West. At a time like this, proactive communication within the market is not only desirable, it is critical. In summary, the global capital markets are in turmoil and will likely continue to be so. Asia is not immune to the effects, whether in our trade or financial markets. Our economic fundamentals continue to be compelling for relatively stronger economic growth. The consumption story of Asia is now well recognized and is spurring many new industries. The rate of urbanization and the great demand for infrastructure is well articulated. Financial resources in the region are also abundant and available. We can be swept away by the wave of negative current in Europe, or we can continue to deepen our domestic and regional capital markets and ensure the availability of growth capital. The choice is ours. Ladies and gentlemen, I believe that we should see bleak times not as a threat to Asia's incredible growth story, but as a challenge to be proactive in supporting regional markets and to differentiate the region more aggressively. I am convinced that Asia can emerge stronger than ever from these trials and provide invaluable support to the global economy, providing that the region comes together in closer partnership. Ladies and gentlemen, thank you very much for your kind attention.
Thank you very much, Mr. Jose Camacho, who is the Managing Director and Vice Chairman of Asia Pacific Credit Suisse. And like other sessions, I would like to ask the floor whether or not you have questions.
Let's break the tradition of silence.
Any questions? No. Fine. Thank you very much once again, Mr. Camacho,